We saw a reasonably strong performance on US equities markets. How much credit for that can be parked at the door of Jay Powell?
Pretty much all of it. I think the earnings news we got today was actually kind of negative, so I think it entirely rests on the idea that the Fed has launched into at least one cut and probably many more cuts in a new easing cycle.
Yeah, in terms of how many more cuts, though, the data keeps being unhelpfully helpful, really. We had that very nice US jobs report, and now we've got, as this chart demonstrates, some pretty good numbers on the core consumer prices for June. You can see inflation showing signs of life there. So if this data continues to be supportive, the Fed being data dependent, that kind of kneecaps the argument for more cuts down the line, doesn't it?
Well, I think the Fed chairman is a very calm guy, but the one thing that he was passionate about, I thought, in his testimony was the idea that that over the last few years, people who have had lower levels of skills, low levels of income, have actually started to see some increase in jobs and in pay. And the level of inflation, as measured by the CPI, is running at 2.1%. By the Fed's preferred measure, it's running a bit below 2%. And the Fed has been very clear that they think that 2% target is symmetrical. That is, they've been running below it most of the time for the last several years, as of every other central bank. And that means that they would also be willing to tolerate inflation somewhat above that if it achieved their objectives of getting full employment and by that definition of 2%, stable prices. So I don't think the Fed will be spooked too much by the latest CPI number. I think they'll want to see a series of numbers that are at or 2% before they reconsider the course of cutting interest rates.
So what are you expecting then for the rest of the year? It seems that 25 basis points are already priced in for the July meeting. But what about the rest of the year? 2 more cuts, 3 more cuts?
Well, I think it depends on the data, as we were just talking about. But I would think at least one more cut. That would basically get U.S. real interest rates to essentially zero. And even at zero, that would still leave them the highest basically in the developed world. During the old internet age, people used to say that information wants to be free. Well, in today's world, it seems as though money wants to be free, at least in inflation-adjusted terms. So I think we'll probably get there. That would be, in other words, 2 more cuts from where we are today. Whether we get 3 or not, I think will depend a lot on whether the inflation data does start to show signs of perking well above 2%, or whether the economy, which the data has been thoroughly mixed in the last few months. So yes, we've had some strong readings, but the PMIs, for example, have been poor. It looks like the soft data has been soft, but the hard data on things like jobs has been a bit stronger.
Let's talk a little bit about the stock markets, because we continue to see small caps lagging the broader market. This GTV chart on the Bloomberg showing what the Russell 2000 is doing in terms of valuation P of the Russell 2000 against the S&P 500. And we're seeing the biggest discount in well over a decade. How does this bode for the rest of the economy? Could we see the rest of the large caps follow small caps lower?
I think that's a very good point. I mean, a lot of the gains in the market have been driven by those large cap growth, especially tech stocks. And having a more narrow market where a relatively small number of stocks are really powering ahead, and there are whole sectors like finance and energy and whole market cap portions like the small caps trailing, that's not a really healthy sign. So I would much prefer to see the small caps join in the large caps with a rally. And the fact that they haven't is, I think, at least some cause for concern.
So in terms of looking for gains in the rest of 2019, what potential do you see, if any?
I don't think we're going to see a lot of gains from here. We've had a tremendous run. We've had a tremendous run despite the fact that earnings growth is going to be quite weak this year, probably low single digits, and maybe a little better next year, but I wouldn't expect it to be a great deal better next year. A healthier stock market is one where earnings are driving the bus, as they always do over a long period of time. And when you have a market where valuations, increases in valuations, have been responsible for the gains, that's a little bit more problematic. So we've had valuation gains. That's why the market is up so far this year, partially because low rates have led people to take more risk in the stock market. But I wouldn't expect to see valuations rise that much from here. And so I think we'll see some gains, but I wouldn't expect very much out of the market for the second half.